Imagine you walk into a bank. You hand the teller $10,000 in cash. Real money, earned money. You worked for it. You saved it. You drove it there in your car. Now here is the part they do not put on the brochure. The moment you hand that money over, the bank is legally allowed to lend out about 9,000 of it to someone else, while it still shows up in your account as yours. That is not a metaphor. That is not an exaggeration. That is Tuesday. And once you understand how that actually works, the way you see every mortgage, every recession, every bailout, and every dollar in your wallet will be permanently different. So let us start at the beginning. Most people believe, in a vague, comfortable way, that banks are like vaults. Money goes in, money sits there, money comes out when you need it. The bank in this story is basically a very secure mattress with better customer service. This is not what banks are. Banks are not warehouses for money. They are machines that manufacture it, and they do this so quietly, so legally, so ordinarily that almost no one stops to think about what that means. Here's how it actually works. You deposit $1,000. The bank is required by law to keep a small fraction of that on hand. This is called the reserve requirement. In the United States, it used to be around 10%. In 2020, the Federal Reserve quietly dropped it to 0. But let us use 10% to keep the math clean, because the principle is the same. So you deposit $1,000. The bank keeps 100. Then it lends out 900 to someone else. That someone else, let us call him David, uses the 900 to pay his contractor. The contractor deposits it at his bank. His bank keeps 90, then lends out 810. That 810 gets deposited somewhere else. That bank keeps 81 and lends out 729. Do you see what is happening? Your original $1,000 has now become, through a chain of deposits and loans, close to $10,000 circulating in the economy. The money did not appear out of thin air in a dramatic way. It appeared out of thin air in a very boring spreadsheet way. And that's somehow more unsettling. This is called fractional reserve banking, and it has been the backbone of the modern financial system for centuries. Now, the textbook version of this story tries to make it sound orderly, controlled. The banks lend, people borrow, the economy grows, everyone wins. And for long stretches of time, that's roughly what happens. But here's the detail the textbook leaves out. The vast majority of the money in circulation right now was not printed by a government. It was not minted. It was not approved by Congress. It was not stamped on a coin. It was created by a commercial bank as a loan the moment someone signed a mortgage or took out a line of credit. The Bank of England, not exactly a radical institution, published a paper in 2014 explaining this plainly. They wrote, and this is a direct paraphrase, that the common belief about how banks work, where deposits fund loans, is actually backwards. In reality, loans create deposits. Read that again. Loans create deposits. When your bank approves a mortgage for $300,000, it does not go into a vault, find $300,000 and hand it to you. It types $300,000 into your account. That's it. The money did not exist before that moment. Now it does. And now you owe interest on it. For 30 years, the bank created the principal. You're paying back the principal plus interest. Where does the interest come from? Other loans, other created money. The whole system requires perpetual expansion to function. Stop the lending, and the money supply contracts. Contracts enough, and you get 2008. Let's talk about 2008 for a second, because it's the clearest recent example of what happens when the mechanism breaks. Banks had been doing what banks do, creating money through loans. But in the years leading up to the crisis, they had gotten very creative about it. They were packaging those loans into securities, selling them to investors, getting those securities rated as safe by agencies who had a financial incentive to call them safe, and then using those ratings to justify creating more loans to package into more securities. It was money creation stacked on money creation. Derivatives of derivatives. Someone once described it as a wedding cake made entirely of wedding cakes. And when the underlying loans started defaulting, the whole structure didn't just wobble,
It threatened to take the global financial system with it. The response was remarkable. The Federal Reserve and the U.S. Treasury moved to stabilize the banks. Trillions of dollars were injected into the system. Some of it was loans, some of it was asset purchases, some of it was guarantees. The technical term used at the time was bailout. The unofficial term, used mostly by people who didn't get one, was something less printable. The banks that created too much money in the wrong ways were saved with newly created money by the institution that, in a different way, does exactly the same thing. There's no clean villain in this story. That's what makes it interesting. Now, zoom out slightly, because this is where it gets quietly philosophical. If money is created by debt, and debt requires growth, then money is not a thing. It's a relationship. It's a claim. It's a promise dressed up in a currency symbol. When you have $1,000 in your account, what you actually have is a promise from your bank that if you ask for it, they will give it to you. But if everyone asked at the same time, they couldn't. That's not a secret. That's a fundamental feature of the design. It works as long as most people don't ask at the same time. The moment enough people decide to ask at the same time, you get what is called a bank run. And bank runs have a way of becoming self-fulfilling prophecies. The bank looks fine. Then people hear it might not be fine. They pull their money. Now it's not fine. The rumor created the reality. This happened with Silicon Valley Bank in 2023. A bank with hundreds of billions in deposits effectively collapsed over the course of a weekend, partly because word spread quickly on social media that something might be wrong. In the age of smartphones, a bank run that used to take weeks can happen in hours. The system has always had this fragility built into it. We've just gotten better at triggering it faster. Here's the part that tends to make people uncomfortable when they sit with it. If money is created by debt, and debt requires growth, then economic growth, as we currently measure it, depends on a continuously expanding pool of debt, not metaphorically, mathematically. For the money supply to stay stable, the amount being borrowed has to roughly match the amount being repaid. For the economy to grow, borrowing has to outpace repayment. More loans have to be created than retired. More money has to be manufactured. This is not a conspiracy, it's arithmetic. And it has been baked into the structure of modern capitalism for a long time. What it means in practice is that an economy that is not growing is, by the logic of the system, failing. There's no neutral. There's no steady state. The machine needs fuel to keep running, and the fuel is new debt. Some economists will tell you this is fine, that growth is the natural state of a healthy economy, that the alternative is worse. Most mainstream economic discourse politely avoids sitting with that tension for too long. Here's one more layer worth pulling back. When central banks like the Federal Reserve create money, it's called monetary policy. When they inject liquidity, as they did during the financial crisis and again during the pandemic, they're doing something structurally similar to what commercial banks do, just at a different scale and with different mechanisms. In 2020 alone, the Federal Reserve expanded its balance sheet by nearly $3 trillion in a matter of months. This was not tax revenue. This was not savings. It was new money, created because the institution with the authority to create it decided the situation required it. The official framing is that this prevents economic collapse. The critical framing is that it also inflates asset prices, meaning the people who already own things, houses, stocks, land, got wealthier in proportion to the new money created, while people who own mostly labor and cash did not. Whether you think that was the right call depends largely on where you were standing in 2020. So here's where we land. The money in your bank account is not stored there, it's promised there. The dollars circulating in the economy were mostly created by banks extending credit. The system requires continuous expansion to function, and the people with the authority to create or destroy money have an enormous amount of quiet, unelected power over everyone else. None of this is hidden exactly. It's published, documented, explained in central bank literature and economics courses. It's just rarely explained in the kind of plain language that makes you feel what it actually means. Because here's the real question the system doesn't have a clean answer to. If money is created by debt, and debt requires growth, and growth has limits, physical, ecological, social, then what happens at the edge of that limit?